Ladies and gentlemen, welcome to WealthDom. My name is Nobu PM, and today's episode we're going to go over multiple earnings that we received today. Today is November 20th, 2024. Several major companies have reported their earnings, and they provide insight to their financial health and strategic directions. So let's get into the key highlights, performance metrics, and future outlooks for the companies of Target, ticker symbol TGT, NIO, ticker symbol NIO, WIX.com, ticker symbol WIX, and TJX company, ticker symbol TJX, and of course, Williams-Sonoma, ticker symbol WSM. I'm going to start here with Target, which engages in operations and ownership of general merchandise storage. Now, they reported earnings today. Their earnings were terrible and they're missed, and the stock is down 21.14% on the day, and they're pretty much down. So if you take a look at year to date, they're also down on the year. So if we put about it in January, it would be down 47%, and on a year you're down minus 5%. So let's talk about the earnings. So corporate sales increased by 0.3%, driven by 2.4% rise in guest traffic and 10.8% growth in digital sales. Growth margin rate slight decline of 27.2% from 27.4% last year, primarily due to higher digital fulfillment and supply chain costs. So the total revenue grew 1.1% from 25.7 billion. Earnings per share, GAAP and adjusted EPS of $1.85. That is earnings per share, down from the 2.1 in the previous year. So the outlook for the Target company, they expect to be pretty much flat. Comparable sales and EPS and range of $1.85 and $2.45 for the fourth quarter. So pretty weak report from Target. Their forecast analysts predict Target's earnings and revenue to grow by 5% and 2.8% per annum respectively, with the EPS growth of 6.5% per annum. So pretty much awful for Target. Target's performance reflects a balance between growth in digital sales and challenges in maintaining margins. Of course, the increases in guest traffic and digital sales highlights the company's successful efforts in enhancing customer engagement and online presence. However, the slight decline in growth margin indicates ongoing pressures from higher fulfillment and of course supply chain costs. So looking ahead, Target continuous outlook suggests a focus on stabilizing performance aimed at a competitive retail environment. So let's do here a risk analysis for Target. Should you buy this stock at the current price? Do not forget they are one of the dividend kings. They yield a 2.87% dividend for the entire year. The EPS is 9.71, which is great. So let's do a couple of calculations. The PE is currently at 16.11. I don't know if this is already adjusted, because if we take our 1.24, let's do here a quick calculation. A PE of a price of $124 a share divided by the EPS of 9.71, going to get a 12.78 PE. So this is a really good PE. So I'm going to say here PE up in 78, which is less than even the 15, because this is not a growth stock. So 15 PE, and it's, I would say, a low risk right now for Target at its current price of $124. Now let's continue on. They have triggered their RSI is currently, and this is a 1 year chart, okay? This is a 1 year chart. Their RSI is at 24.88, which is a very low risk. And if it goes lower, it's less than 30. We're going to add disk, then we're going to add this. Then the MACD sell wrong. So once again, a low risk, but the outlook, let's just say if we would go here, let's say their forecast, they're forecasting, most of the analysts forecast, a above market return of 43%. So we're going to say that this is a outlook 43% growth year to year, and this is above the average of 8% of what we are looking for. I'm going to say that this is a very low risk currently. Okay, so we are at 15% risk. Is this affected by global or geopolitical problems? Mostly not. This stock is very overbought today. Is this a long-term investment? Is this a trade opportunity? I would say yes to both. Now, Target does all-time high. Now, Target is basically roughly at 50% of its all-time high, remember, so it's $267 and it's at 120 feet up. It is even under, it's even under 50% of its all-time. Could it go further down? Possibly, but at this current price, Target is a bargain. I would say that all metrics point into a buy signal for Target for even a short-term trade, or even maybe a long-term investment. But you know what? Let me hear your thoughts. What do you think about Target? Is it buy? Is it sell? Leave it in the comment section below. All right, so the next stock we're going to analyze here, they also reported their earnings, is NIO. Now, NIO is a Chinese holding company which engages in design and manufacturing and sales of electric vehicles. After they reported earnings, their stock is up 1.75% for the day, but they're pretty much down over 47.25% on the year. So take care with this stock. Now, let's go over their earnings report. They reported delivery of 61,855 vehicles, making a 11.6% increase year over year. Total revenue reached a RMB of 18.67 million, so it's roughly $2.66 billion, a slight decrease of 2.1% from the same period last year. Gross profit surges by 31.8% to a 2.01 billion RMB, which is roughly $286 million, with a gross margin improvement of 10.7%. A net loss reported at a 5.06 billion RMBs, which is roughly $721 US, reflecting a 11% increase year over year. So the strategic initiative continued investment in production lineup, and strategic initiatives include a launch of the NIO L60 and significant investment in NIO China. So for the forecast, analysts have a average price target of $7.49 per share, with a potential upside of 47% from the current stock price. Now, NIO is expected to grow earnings and revenue by 40% and 20% per annum, respectively. So NIO's earnings report underscores its growth in vehicle deliveries and gross profit, despite a slight dip in the total revenue. The improvement in gross margin is a positive sign, indicating better cost margins and operating efficiency. However, the increase in the net loss highlights the financial strain from ongoing investment in new products and market expectations. Now, NIO's strategic focus on innovation and market presence, particularly in China, is crucial for the long-term growth prospect. So let's do a risk analysis of should you buy NIO at the current price. So currently, NIO is trying to trigger a buy signal. A MACD, and I'm just going to skip over the P because they don't have a P. Even if I try to have a negative earnings per share, so if I try to find out their P is going to give me banana or something like that. So I'm not going to do that. But what we are going to do is analyze what we have. So a MACD on a buy trigger. This is a medium risk. RSI is at 45, which is also a medium risk. The long-term outlook for the forecast was pretty good. They are focusing 40%, which is above, of course, our 8%. So 40% over the long term of 8%, and there's going to be a very low risk. Now here comes the big one. Are they influenced by geopolitical risk? Of course they are. Now I'm going to say, your risk. I'm going to say that this is very high. Was the competition? Well, Tesla. And because the competition is Tesla, and Elon Musk is now in the president's ear, or the president-elect, I would say that this is also a very high risk for the long term, especially for, let's say, the next 4 years. So I cannot look more than that and say that in 10 years, NIO is going to beat Tesla. But in the next 4 years, it's going to have a hard competition because of, well, regulation in the EU and, of course, tariffs in the US. So on the short term, I would say that this is not a buy. And for the long term, I would also say that this is a high risk for buyers that want to invest long term in Tesla. So this would be a short term, lower risk for from here to the next year, the low risk or a medium risk. But for the long term, it would be a high risk. So I'm just going to leave it at that. And let's move on to the next one, which is WIX. So next up, let's talk about WIX.com. This is WIX.com Ltd operates in cloud-based website design and development platform. Basically, you can create your own website with drag and drops. So that's what WIX does. They report earnings today. Their stock is up 11.14%. They're up on the year. Year to date, they're 68.68%. And on the year, they're 110% up. So exceptionally good returns for WIX. Let's go over their earnings report. Total bookings achieved 449 million, up 16% year over year. The total revenue reached 444 million, and it is up the increase of 13%. The free cash flow margin expanded to 29%, reflecting strong bookings and operating leverage. Product initiative, well, they have a growth driven by WIX Studio, AI power tools, and increased commerce activity. So their guidance for the year was rise full year guidance, now expecting booking growth of 18% year over year and a revenue growth of 13%. So they have a very good forecast. Analysts have a average price target of $190 per share with a potential upside upside of 5.4% from the current stock price. Company expects continued growth, acceleration, and margin expansion into 2025. And let's take a look at their a detailed analysis. WIX.com's strong performance is driven by robust growth in bookings and revenue, supported by successful product initiative. So basically, the expansion for the free cash flow margin indicates effective cost management and operational efficiency. The company focuses on AI power, which of course gives them a bit of boost for AI power tools and commerce activity positions in well for continued growth. They raise their full year guidance, which reflects confidence in sustaining this momentum. Okay, now let's do a quick analysis on WIX. Their forecast for the next year, their the average forecast is negative. Pretty good, excellent, because you know what, their price is high. So of course we see here a upwards trend in their EPS, in their revenue, but they are extremely high. So how high can they go from here? Now let's do a little bit of risk analysis. So let's jump to our risk analysis. Let's go there. Let's start out with their PE. They have a current PE, but let me check this stating as well as I wish. So let's say stock price 207 divided by their EPS of 1.32. So their PE is even higher now. It says 156. So PE of 156, PE 156%. That is, I don't even care how much it is over the 25% of a average PE, and we're just going to say that this is a extremely really high risk. They're currently on a MACD strong buy, so that is also very high risk. Their RSI is at 76, which we're going to, that's a very high risk. Their forward price target here is at 0, so let's say they're not going to grow at all next year, less than 8% what we expect. So it's a high risk. And now for geopolitical risk, so you have one guess where VIX is actually situated. It is in Israel. So we're going to see geo risk very high. Sorry about that, but that's just the way it is. They're situated in Israel and they're having slight problem, let's just say so. So we're going to say that for the long term and the short term, I wouldn't bet on VIX. So stay away from it. If you have it, hold it. Consider taking some profits if you're at these levels, but short-term trade or a long-term holding in the moment, I would suggest wait for a retracement in price and then let's do another evaluation when they're getting there. Okay, let's continue on our next stock. The next company that reported earnings is Williams-Sonoma. This company engages in retailing of home products. It's basically a conglomerate. So they reported earnings today. They reported exceptional earnings and they were rewarded by the stock market with jumping a 28.42%, and they're up also year to date 75% and on the year 95%. So they're pretty much up there in the nose bleeding seats. So let's go over their report. So diluted EPS increased by 7.1% to $1.96 per share. Operating margin achieved a 17.8%. Comparable brand revenue declined by 2.9%. The gross margins improved by 230 basis points and 46.7%, driven by higher merchandise margins and supply chain efficiency. They also announced a stock repurchase of $1 billion stocks repurchase. $1 billion stock repurchase is amazing. So they are to reduce their shares outstanding. They raised their full year guidance, now expecting a revenue decline of 1.5 to 3% and a operating margin 70.8% to 18.2%. So the forecast for Williams-Sonoma is expected to maintain strong operating margins and continue to its strategic initiatives into driving growth. So at the end, Williams-Sonoma earnings reported highlights of a solid performance with improvement in EPS and gross margin despite a decline in comparable brand revenue. The increasing gross margin reflects effective cost management and supply chain efficiency. The new stock repurchase authorization indicates strong confidence in the company's financial health, and they raised their full year guidance suggested a positive outlook with expectations of maintaining strong operating margins. So let's do here a risk analysis for the stock. Their current forecast for the next year is that the stock will decline. So we're going to take here, I don't know, min max. We usually take the average. So let's take average minus 18%. It really doesn't matter. So if I take a growth of minus 18%, we are not going to do here much more, just at a high risk. Now its RSI is currently at 80, which is higher than 70. So we're going to go with very high risk. The MACD is on a strong buy. So a risk for a decline in the price is very high. The stock is at new all-time high, which is a very high risk. And geopolitically, I don't see any kind of problems. I don't see also any kind of, so they have the share repurchase, share purchase. The rep is a low risk. And well, still, we could just leave it there that do not touch the stock for a trade or even for a long-term buy right now. I would say that you should wait a big decline in the stock price because we didn't even do a PE of 16. Unbelievable. So let's do the PE. Oh, let's do here a quick calculation. We have a $174 and a EPS of 4.80 of 8.44, and that is 20. And 20 is again a high risk. So let's just add E20. Well, less than, it's a growing stock, less than 25. Yeah, actually a medium risk. Yeah, but it didn't change that much. So I would say for the short term, short trade, don't touch the stock. For long term, wait. So I would just say hold. Hold if you have Williams Sonoma, consider taking some gain, and if not, hold it forever. It seems that it's going to go do pretty great even in the long term. But who knows? Many things can happen from here to eternity. Okay, so that was pretty much it for today's earnings. Remember, tonight we have three big ones. We're going to start out with Snowflake, then we're going to have Palo Alto Network, and then the very big one, which is Nvidia, is going to report earnings. We're going to, of course, analyze their earnings. So stay tuned to the channel. Don't forget to share, like, and subscribe. Also click the notification bell in order to get notified when we post new videos. With this being said, catch you next time. Bye-bye.